What's going on, guys? Hope you're having an absolutely fantastic day. In this video, we're going to be talking about why Silicon Valley Bank is down a staggering 60% today and another 25% after hours, right? So let's just get into it. So Silicon Valley Bank parent SVB Financial plunged 60% on Thursday after the company completed a 21 billion fire sale of its bond portfolio, which led to a loss of 1.8 billion and spurred plans to raise capital from investors, right? So the keyword in this sentence is fire sale, right? So now the question becomes, why are you fire selling bonds, right? And if you've been following my channel, you know this is the same scenario which is happening with Silvergate Capital, right? Which is their whole balance sheet is upside down because they bought bonds with their depositors' monies, right? So their depositors are basically back 1-to-1 because you're a bank, right? So they give you $1, you do whatever you want with the dollar, just make sure you give me back the dollar. But what happened is they bought bonds which are considered safe investments, but they bought the dating is too long, right? So the timing is too long. And then what ends up happening is when rates go up as fast as they have recently, right, the value of those bonds come down, right? So again, if you can wait it out, it's no problem, right? Because the government will give you back your money, right? But in this case, these banks cannot wait it out, right? So the bank said it would raise 2.3 billion from investors selling stock, essentially diluting shareholders to cover the losses related to the bond sale. So basically what happened is they have 21 billion in this bond portfolio. They sell it and then they have a loss of 1.8 billion, and now they want to raise money from shareholders to cover up the losses, right? According to SVB Financial's updated investor deck, the company's 21 billion bond portfolio had a yield of 1.79% and a duration of 3.6 years, right? So this is basically, these banks are being very, very short term, right? At a time where the yields were very low, they still had to buy, right? And I'm not blaming it purely on the banks, right? Because I think the Federal Reserve and all the state governments and federal governments also forced these banks to do things like this, right? So another issue with the bank is also that it basically lends to a lot of these pre-IPO companies, right, which rely on the IPO market to basically cash out, right? And this is, I think, a scourge of Silicon Valley right now, right? Basically, they build companies to dump on the public, right? Look at Coinbase. They went public at $100 billion valuation. Now, what's the valuation on that? I think it's 15-16 billion, and plus they diluted shareholders, I think, by 2x during that time, right? Basically, their share count doubled during that time, something like that, right? So it's very, very insane, right? What is happening with all these tech companies. So in other news, Peter Thiel's founders fund advisors companies to withdraw money from SVB, right? And this is the problem if you're a bank, right? Anytime there is even 1% chance that your solvency is questioned, right, or your liquidity is questioned, right, instantly everyone will just pull out their money. They don't care what you say, what you tell them. So they will just pull out their money, right? Because for me as a depositor, what's the point I keep my money with you if there is any chance, even a slight 1% chance to for you to lose my money, right? Basically for you to go bankrupt, right? And if you go bankrupt, for me as a depositor, obviously I'm FIDC insured, right? But it's only up to 250,000. And with all these funds and all, you have to realize that they have hundreds of millions, right, in this one bank account or something like that, right? I know it's quite crazy and unfathomable, right? But it's actually out there. So if the bank defaulted, first of all, you're not even sure whether you get back your money, right? Second of all, even during the bankruptcy proceeding, right? Because you have to understand, this bank particularly is lending to all these cash burning companies, right? So if they don't have the liquidity for maybe 6 months or 12 months, right, their company is going to go bankrupt, right? So if you take a look, I think SVB will cause a huge knock-on effect to all the startups, right, if they're not already pulling their money out, right? Which is why, in my opinion, I think there is almost 100%, or let's call it 99.9%, SVB actually there's a bank run on it, right? So whether they can survive the bank run is something else, but there will be a bank run for sure, right? So either one or two things will happen. Either there's a bank run on SVB because all these startups are saying, okay, I need to get my money out of here, put it in JP Morgan or something like that, more stable, so I don't lose all my money. Or the second part is there is no bank run and SVB actually still goes bankrupt, then the startups will be screwed as well, right? Because if all your money is stuck inside that. So I think the most likely scenario is there will be a bank run on SVB, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel, and also watch till the end, right? Because obviously you don't want to miss any important information. So I think currently you can see the consequences of interest rates being hiked very quickly, right? Because interest rates being very, very low as they have been for the past 10 years, and especially during this 2020 to 2022 period where the Fed was signaling that they won't raise interest rates until 2025, right? At that point. So at that time, people's planning changes a lot, right? Because if you know that they are not going to raise rates until 2025, so why would I take a fixed rate mortgage? Let's say if I really believe the Fed, and I don't think for myself, why would I take a fixed rate mortgage which is 1% higher than a variable rate mortgage if the Fed's going to keep the rates at 0% anyways? Why not I just take the variable mortgage? But if you took the variable mortgage, I think the 30-year now is trading at, I think, 2.5 times the bottom, right? So let's say the bottom was, I think 1 point something or 2 point something percent. Now it's nearly 7%, right? So if I plan my life like that, right? Can you imagine what is happening now? I'm probably going bankrupt now, right? Paired with the fact that people are losing jobs left and right, even though the unemployment market is not showing up yet, particularly for tech firms, right? They have been losing a lot of jobs, right? So like tech firms have been going through a bear market of their own, right? So if now you think about it, you combine all these factors. First of all, the Fed says that, okay, we're not going to raise interest rates. So companies will plan accordingly to, they are not going to raise interest rates until 2025. But I mean, if your founders were a bit smarter, they would have realized that that wasn't a possibility. A lot of people, even at the end of 2021, they gave you a lot of time, right? So end of 2021 to 2022, you had a lot of time to restructure your debt and do all these things, right? One of the things Meta did, which was really, really smart, right? I think they raised money, I think 10 billion at about 1.9 or very low rates, less than inflation currently is now. I think they already made 2 years off their money just off inflation, right? So you can see that if you have a good leader and you have a good CEO, that they can weather all these storms, right? And this is another warning against investing in banks if you really don't know what you're doing, right? Because banks can always do this. So they go up over a period of a really, really long time. So let's say if you're an investor here, you did a 700x from $1 to 700 here, right? You did a 700x, and now you just lost about 620x of your gains, right? Just overnight, right? So that is a warning against investing in banks if you don't know what you're doing, right? So obviously it wasn't just overnight, it was in a year, right? But it's still very, very painful, right? Year and a half. So what can we learn from this SVB situation, and what are some practical advice that we can use out of this situation, right? You can see, first of all, I think one of my tenets would be that I would avoid investing in financial institutions, right? Even look at JP Morgan and Chase, right? They trade at a PE ratio of 10, right? So arguably, banks are actually very, very cheap, right? But if you don't know what you're doing, you can go from very, very cheap to even cheaper, right? Such as this SVB bank in just one day, right? So that is something to be really, really wary about. And 11 PE ratio for JP Morgan and Chase obviously is lower than the S&P 500, but I think I can find similar or even better returns, right? Without taking all this financial and credit risk, right? Which I think is a very, very big risk nowadays, especially when the Fed funds rate just went ballistic just like that, right? So a lot of these firms actually have a lot of underlying issues. That's why you can see that even Wells Fargo is down 6%, Citigroup down 4%, JP Morgan and Chase down 5.4%, and all the banking stocks basically down a lot, right? Because this is the market trying to price in the risk that a lot of these banks actually have all these issues, right? And I wouldn't put it past them, right? Because I think this issue is very, very systemic, right? Because if you encourage all these bad lending standards, and bear in mind that even the banking standards are very tight in the US, there are bad loans and all this, right? Because of the low interest rates and the reach for yield, right? And if anyone else is looking for the next big shot, that you can do 60% in one day, please tell me, right? Because I'm also looking to find it, right? But I think at this point in time, something that I'm looking at is actually Signature Bank, right? And I probably should have bought a bit of put options or took on a short position for this, right? But I really wanted to stop shorting stocks and basically just try to go long only, right? But I think put options would have still been acceptable, right? And when I looked at this Signature Bank, it was like a $12 billion valuation, right? So if I bought options at basically just the start of the week, I'll be making a lot of money, right? So I actually took a look at Signature Bank in the middle of February, right? When Silvergate had its first 50% plunge, something like January or February, somewhere there, right? But I didn't really dig that much deeper, right? Because I don't really want to go short on these things that are trading at 4.4 times price to earnings ratio, right? So the only issue is if they go under, then obviously you have that 100% downside, upside, right? The downside for them, which is upside if you're buying put options. But at the same time, I'm shifting my mind to focus on more long term and less of all this shorting, right? Basically, this was not an opportunity I acted upon, but if I did, I would have made a lot of money, right? So boohoo, very sad for me. But I really don't hope that all these banks go under, right? But I'm saying that there is a high likelihood that a lot of these banks are going the way of Silvergate Capital and currently Silicon Valley Bank, right? So another situation that I really want to warn you guys about is really this, right? So you can see this guy basically bought a $190 put on SVB, right? Which is our Silicon Valley Bank, right? And the gains are staggering, right? So 92,300% gains, right? Just in one day, right? So can you imagine that? Oh my god, so much gains, right? But if you take a look at the strike date, right? So it's basically March 17, 2023, right? And basically that is 7 days from now. So 5 trading days, right? This person couldn't have possibly known that Silicon Valley Bank was going to have this massive move down, right? So either they have insider information or they were just gambling and they got lucky, right? So I really do want to warn you guys against FOMOing into things like this, right? Because you see something like this and you think it's your chance to get rich, right? But the options are expiring in 5 days, and basically before today, I think the stock was at 267, right? So there was like a 99.9% chance that these options would have expired worthless. It's just that he got lucky, and we can't depend on luck when we're investing, right? Especially when you're investing for retirement or something like that. And don't think that, oh, I'm 20 now, so my retirement is really far away, so I can afford to gamble away my life savings up to now, right? Even if you have $10,000 when you're 20, that is worth a lot when you're 40 or 50 or 60, right? So always think about the long term, right? Obviously, it would be really amazing if we could always do these YOLOs and make a lot of money. But if you didn't have the intuition to do it in the first place, now that you see people making a lot of money off these strategies, don't FOMO in, right? Because chances are big money has been made. The risk that you're taking is much higher, and the premiums that you're paying for these options are also much higher than they did when they place all these bets, right? So yeah, that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.